Aloha and good morning. It's a pleasure to be here, and I'd like to first thank the state of Hawaii for including me and AECOM for this important day of discussion around carbon markets, offsets, and opportunities in Hawaii. I know we've already kind of had a deep dive into a lot of terminology that Michael discussed, and I'm going to be revisiting some of those terms, but really going to focus my talk on the role of markets, how offsets interact with various markets, and then talk through some of the details on developing projects, transacting projects, and then looking at some trends and things that we're monitoring currently in the various markets out there. As Aaron mentioned, my background is in environmental markets. I serve as the managing director for Nature Bank. We are a global project developer working in a number of different markets and jurisdictions around the world as it relates to carbon development, as well as looking at other ecological assets within different project categories. I feel I also need to mention that I wear another hat. I serve as the co-director of the Oregon Business for Climate. So I'm from Portland, Oregon, and we in Oregon right now, as we speak, are very close to passing an economy-wide cap and trade program. And the Oregon Business for Climate initiative has been the result of the last 2 years of bringing business and industry together to help shape that policy. And I mention that only because there's a key component within that legislation that looks at offsets and the usage of offsets and how that can be linked to California and basically the broader Western Climate Initiative. So I'm going to talk about that in a little bit, but again, thank you for the opportunity to be here. I'm juggling a few different slides here. So real quick, Nature Bank, as I mentioned, we are kind of a full suite project developer. We work primarily in land-based forest management projects and cover the whole process of origination through commercialization. We work with a number of different parties. We refer to as clients or partners, ranging from governments, landowners, private for-profit companies, NGOs, and also over the years I've built up a lot of relationships with Native American tribes, First Nation groups, and indigenous communities that we work with to develop projects. So I'll talk a little bit more of that in a moment. So when we talk about carbon markets, essentially what we're referring to is a program that allows for trading of carbon emission allowances or offsets. And I'll explain the difference of those two products in a bit. But essentially what the market does is it incentivizes companies and countries to reduce their emissions at the lowest cost option, while also focusing on financial incentives and innovation. There are two markets that Michael already spoke to and you're likely familiar with, voluntary and compliance. I'll get into more details on that. But overall, carbon markets to date, this is not a novel idea. They exist in 45 jurisdictions and 25 subnational or locations, all of which represent $82 billion in market value. And that's from the World Bank's latest report of last year. So it is an idea that has been around for a number of years, and we're seeing more expansion of markets, albeit they're more regionally focused. So just expanding just a bit more on the difference between compliance markets and voluntary. Likely you know most of this already, but compliance market really looks at a government-regulated program where there's a mandate to reduce emissions based off of set targets. Two examples of that would be a cap-and-trade program, or which is also referred to as a market-based approach, or a carbon tax. And then there are different hybrids that exist within that, but I won't get into the details about that. But overall, fundamentally, when you're looking at compliance programs, we're really talking about either a cap-and-trade or a tax program. Outside of that, we have what's called a voluntary market. And voluntary markets have been around for a number of years as well. And they are really based off of, as the word describes, a voluntary commitment, usually driven by corporations or individuals, to reduce greenhouse gas emissions. Voluntary markets also exist globally, and they also coexist with compliance markets. They offer more flexibility, but the market size is much, much lower than compliance markets, and I'll speak to that in a little bit. Another important takeaway is that voluntary markets historically have also served more or less as an incubator to compliance markets. And so it's kind of like a testing ground for different types of project categories and market systems. So here, I'm going to try the laser pointer here. Here we go. So this slide more or less points to globally where carbon markets exist right now. And some of these are in operation, and I'm going to speak to what's happening in North America shortly. But it's a good visual just to understand kind of the landscape. Some of these programs are currently being implemented or are scheduled to be implemented. I'll also just comment that what we're seeing as an outcome of the Paris agreements is that a lot of countries now, through signing up to the accord and agreeing to the targets, are now starting to look at how to adopt carbon pricing or a carbon market within their respective countries, jurisdictions, as a way to meet their targets. The other interesting note here is that China has agreed to launch an economy-wide cap-and-trade program. It's going to be phased in, but that's a pretty significant step forward for the global carbon markets. It will start in a couple years, and as I said, it'll be phased in, but a lot of people are looking to that to see how successful that's going to be. So within North America, and Michael touched on this a little bit, but I just wanted to highlight some of the existing programs that are in place. California has an economy-wide cap-and-trade program that stems back to the Global Warming Solutions Act. And within that program, and I'm going to speak a little more to detail on that at a later point because its offsets are a pretty important part of that overall program, but it also provides linkages to other jurisdictions. And so Quebec is currently linked to California, and Oregon is likely to be the next state to link to what is referred to as the Western Climate Initiative. And so that looks at linking markets as well as offset products. So more or less allowing those products to be fungible between these different states or jurisdictions. REGI is a program that's been around for a while on the East Coast. It represents 9 states, and it's more or less a cap-and-trade model, but focused on electricity, so the utility side, utility sector. They did just recently announce that they will be expanding it to an economy-wide program, so starting to I can't remember exactly when, but they'll be phasing in other sectors within that program. And that's really a result of demonstrating that it's been successful in both reducing emissions while allowing for the economy to grow. Offsets exist in REGI as well, but they are currently very undervalued, so there's not much activity in that space. In Canada, I have offices in Canada, so sometimes I say that. Sometimes I say A too, but there are a number of provincial programs that also fall into the category of a carbon market and where offsets can be used. British Columbia and Alberta both have a system. Most recently, a few weeks ago, the Canadian government also announced the implementation of their federal program, which basically looks to apply a carbon pricing or a tax to provinces that are not currently doing anything. So in this case, British Columbia and Alberta are going to continue to do their own thing, but the other provinces in Canada will fall under a new federal program. And offsets are also being looked at in those jurisdictions as well. So what does all this mean is that a lot of activity in North America, it's very state-driven. It's no secret that our federal administration is not supporting these types of efforts. It's unlikely to see when a federal program would actually come into play. But I would say the silver lining around some of that is that there are a number of states that are really marching forward with putting in their own program or designing a program that can be linked to other jurisdictions. Fingers crossed on Oregon. So when we talk about compliance markets, I brought up the term allowance, and I think Michael also mentioned that earlier. It's an important distinction to make between what the two more or less products are that can be used in an overall carbon market that has a market system. Allowances are government-issued permits that are more or less allocated by the government based off of the overall greenhouse gas reduction targets. And that allocation lowers over time. So the supply of allowances lowers, which is supposed to drive more change. But allowances are more or less either distributed for free or auctioned off. And they're more or less a piece of paper that have a regulated obligation around them. Offsets, as we've learned about this morning, are actual project-based activities. And they represent real reductions, which are typically outside of the regulated framework that a program is issuing allowances around. So it's important just to get those two terms, the distinction of those two terms, because you often have people, as Michael also said, like there's this whole confusion of terminology out there, but there's also the notion that an allowance is the same thing as an offset, and they're fundamentally different. So since we're here to talk about offsets, I wanted to just speak to the role that they play in an overall market. Some of this will be reiterating what Michael already spoke to, but an offset represents the reduction, removal, or avoidance of a greenhouse gas emission, and as we've learned, it's commoditized in a metric ton of CO2 equivalent. They represent a very small percentage of the market, so going back to my earlier quote, on the global market value, that is not the market value of offsets. That's the overall market value of allowances, offsets, and other government pricing initiatives. They're very important in a compliance market because they offer a lower cost solution to regulated entities. And oftentimes what you see is a lot of interest from buyers, and I'll speak to that in a little bit, in terms of the benefits of offsets, but they're also driven to purchase offsets because they're valued less than an allowance is. And the reason for that is that there's potential invalidation risk around projects. So if you think about it, an allowance is basically a permit issued by the government, and an offset is based off of a project activity that a purchaser doesn't really have full control over. And there are a number of situations where that offset credit could potentially be invalidated. And I won't get into all those details, but more or less what that means is that it's valued at a discount. They're obviously heavily driven by supply and demand. And the other important factor is that they provide revenue that's outside of the proceed bucket that is managed by a government program. So allowances typically are distributed back into some form of a fund that then the government or institution will manage, and we'll talk more about this in the afternoon. But offsets, the flow of money is really between the owner, purchaser, and capital partners. So it's outside of that framework. In terms of value add, I spoke to some of this already, but and Michael did as well. But one of the real value adds that we talked about in the Q&A session too is co-benefits. And there are a number of different ways to evaluate and value co-benefits. But what we do as a developer and working in all these different markets is we try to measure the social, economic, and environmental benefits of these projects. That's at times subjective as well, and there's not a necessarily monetary value to that, but a lot of projects do carry co-benefits ranging from increasing biodiversity to economic development opportunities. And the market tends to have certainly interest in that. Unfortunately, it's not a fine line between what that value is. And so what's oftentimes happens is that you're having to market those co-benefits on top of the project or the standard that's already been implemented. And really try and sell that into more or less attract a higher price. So within carbon markets, as I kind of laid out there earlier, there are offset markets. And those resemble quite a bit of what a carbon market is. It's kind of a subset, you could think of it. So compliance markets, as I mentioned, are really a government-mandated initiative. There's a set percentages of offsets that are allowed into a certain program. In California or under the Western Climate Initiative, there's an 8% allocation currently, and then they're actually ratcheting that down by a few percentage points. And in terms of pre-compliance, we spoke about this a bit in the Q&A as well. Pre-compliance is a market that looks at potential policy development. So it's very somewhat speculative. The landfill gas example that Michael spoke to is a perfect example of pre-compliance. Organization that I was working for under the Waxman-Markey federal program, which was in development and then did not get approved. We did a lot of landfill gas projects with the thinking that they were going to be eligible. And we sold a lot of landfill gas projects to what would be considered compliance buyers. And so that is just part of the game you have to play, more or less, when you're dealing with a market that's heavily driven around policy and regulation. Currently, there's pre-compliance activity in some of these Western Climate Initiative states with the thinking that, okay, they're going to get, for example, Oregon, we have drafted some initial offset protocols. They are not approved by any means. The policy isn't improved, but people are already out there speculating, where can I start developing some of these projects in anticipation? So it's kind of like an early action step. On the voluntary side, it's really broken down into corporate voluntary markets, which ranges from large multinational Fortune 500 companies that have been involved in purchasing offsets for various reasons, ranging from carbon neutrality initiatives, internal carbon pricing, to employee-driven programs, looking at their supply chains. So there's a whole slew of activity in that sector, which also tends to, at times, move over to the pre-compliance side of things, because sometimes these large corporations are facing potential regulation in other markets that they operate in. So there's a crossover there. On the retail side, it really looks at small companies, individuals, offsetting your travel to your wedding, to your lifestyle. And that's a very small market, I would say. I wouldn't even call it a market, but it's a channel for offsets to be sold. And typically that's through a third-party organization where you can just log on and purchase a credit or two based off of what you're trying to offset. So within all these different markets, there exists a pretty complicated development process. Offsets are not an easy thing to build. And I oftentimes try to equate them to, you're trying to manufacture something, that being an actual greenhouse gas reduction. That being said, there are some pretty standard procedures that are applied to developing projects, whether it's in a compliance market or a voluntary market. And so here we more or less have just a basic workflow of project development process. Within that, there's a tremendous amount of steps that are required to evaluate the eligibility of a project. So looking at the feasibility, you then go through a very detailed project design development process where you're trying to match it up to the protocol that you're working with, but also documenting all of the project development plans. And within that, a lot of calculations and different formulas you have to adhere to. You then move into the validation and verification process, which is where you're engaging with third-party auditors, is essentially what they are, and they're reviewing your project based off of the protocol or the market that you're developing your project to. And then you have what's referred to as issuance. And issuance is when credits are more or less stamped by the verifier, not literally stamped, but you have a stamp of approval that the project has been verified, and then you receive what's referred to as issuance. As a developer, you're typically taking on the development rights to work directly with the project owner, be it a landowner or another facility. And you can do that in many different ways, but oftentimes you're providing more or less turnkey solutions to developing the project and likely trying to assist in selling the project. in terms of the transactions, there are a number of different intermediaries that exist in the market. Those range from brokers, traders, to retail buyers. And those all serve a purpose for different portions of the market. Is to develop a project directly to an end buyer. Because oftentimes, as you can imagine, if you're going through intermediaries, they're getting a cut of the deal. And oftentimes, end buyers also want to be working directly with the project owner. And that's based off of their contracting requirements and also just having direct access to the end asset, being the offsets. There's quite a bit of legal activity that is involved in developing a project. I wish there wasn't so many lawyers involved, but there are. And that is important to factor in when you're considering a project because there are a number of agreements that need to be kind of standardized agreements for selling a project, as well as just third-party contracting. It's not a tremendous, erroneous or super expensive process, but it does exist. And so when you get down to the actual issuance and the retirement of your credits, that's where the registry comes into play, and Michael spoke about that as well. The registry, more or less, is where credits are held and tracked, and once the project or the credits are issued and purchased, then they're retired, which basically means that you can't sell them again. And so that's important to note, is that that avoids any issue of double counting. So in terms of, now we have kind of an understanding more about how a project, the various steps that go involved in developing a project. There are a number of market drivers that I just wanted to call attention to. And these are important to note because they really have their independent influence on the demand side, as well as they're very interrelated with a lot of other activities ranging from the Paris agreements to what's referred to as social cost of carbon. So I just want to highlight a few of these compliance obligations. We talked about that. The Article 6 of the Paris Agreement is something that a lot of attention is being drawn to as it relates to offsets, because it really looks at defining how offsets will be factored into countries' respective programs to meet their Paris targets. It has not been defined yet, so I just want to make sure that that's understood. But in terms of a driver and if you're in the business or looking at developing projects, it's something important to be considering. Carbon neutral programs, again, we spoke a bit about that. Shareholder pressure is another really interesting driver. We're seeing more and more shareholder pressure applied to large emitters to take action on their greenhouse gas reductions. Shell, as an example, has recently come out with a pretty strong requirement from their main shareholders to the executive team that you need to reduce your emissions by, I can't remember what the percentage is, but it's pretty significant, and start looking at alternative sources of revenue beyond just fuel, and your performance is going to be based off of that. So they're really tying the executives to that type of mandate. Shell has also come out and really made a big pledge, most recently around supporting voluntary projects and natural-based offsets, so looking at forestry and other land use projects. And I jumped ahead, but the notion of social cost, it's important to just understand that there is a social cost that economists look at throughout the world as it relates to greenhouse gases. This is not a fixed number, nor is it an actual tax by any means, but it looks at the actual impact that climate change and greenhouse gases have to society. And so the price can range currently from $40 to a couple $100, but most economists these days are factoring in social costs to both the impact and then to how to apply that to a price on carbon emissions. And so that is a direct intersection with how offsets are valued too. So I just wanted to call attention to that. So we've got an understanding of kind of the market dynamics a bit and some of the drivers. When it comes to buyers, they, again, exist in these different buckets as it relates to the type of markets, and they all have their different profiles. So in a compliance market, you're really looking at large emitters, and those range from oil and gas companies, as I mentioned, Shell, British Petroleum, and Chevron. Those three, more BP and Shell, are the largest purchasers of offsets currently, globally. So they are very, very active in purchasing projects. You also have utilities, independent power producers that are also, actively involved in the market, in addition to what's referred to as energy-intensive, trade-exposed, it's a handful, wordful, EITEs. And those are manufacturing facilities and large industrials. So looking at cement, pulp and paper, semiconductor processors, manufacturers, all of those having a compliance liability. And so they're actively looking for projects. In government, there's a kind of a category around government-based funds and foundations. The World Bank Fund has been involved in the carbon markets for a number of years. They are still somewhat active, I would say, as well as the Norwegian Sovereign Fund, very focused on international projects and RED projects. But those kind of multilateral sources of money are also available when you're starting to look at developing projects. In addition to corporate foundations, we work with one of the largest mining organizations in the world that has a foundation that is out there supporting projects, forestry-based projects, but looking at it from the co-benefit side as well as the actual reductions. On the corporate end, we see buyer profiles, as I mentioned, from the Fortune 500 types. Disney has been active for many of years. Google, Microsoft, Dow. Lyft has just announced that their entire fleet will be carbon neutral, so they're actively out there in the market now purchasing projects. And then there's some other kind of voluntary initiatives, one in particular with airports that looks at about 237 airports that are looking to voluntarily reduce their emissions, and offsets plays a role there. So we referred to offsets earlier as a tradable commodity. And so thinking of it in that context, there's a lot of price assumptions that go into place. I would say it's not a similar commodity to orange juice or cocoa, but it does have a kind of similar type of characteristics when you look at pricing, more specifically in the compliance side of things. But I'll just go through these price assumptions quickly. They're always priced on a per ton basis. So $1 per ton is usually what you'll hear if you're talking to a buyer or an intermediary. There are typical thresholds that are applied, and by threshold I mean actual credits that are generated. And we can talk more about that this afternoon. I'm just getting my notice here. And then there's quite a bit of fixed costs and variable costs. Here is a breakdown of current pricing. There's actual broker quotes that are issued on a regular basis that make this somewhat transparent, but the voluntary market is really hard to track these days. It's just all over the place. But if you look at California, currently at between $12 and $13.63. Alberta has a higher price point on their offsets. Those are just Alberta-based offsets. And then you have a wide range on the voluntary side, 50 cents to $12. So quite a bit of range on the voluntary spectrum where compliance, because you're dealing with actual demand and it's discounted against those allowances, you pretty much have a more fixed view on what that's going to look like. This just represents globally the voluntary market. As I mentioned, it's quite active throughout the world, but the size is relatively small. Granted, this is from a couple of years ago, but it's about a quarter of the size of California's offset market, just to give you a comparison. On that note, just real quickly wanted to touch base on the California cap and trade because that currently is the largest market for offsets. It sets an economy-wide cap that looks at reducing emissions from 1990 levels to 2020, and then recently expanded to 40% to 1990 levels by 2030. Offsets are eligible up to a maximum of 8% of that program. And then they've recently put forward a change in that law which lowers it to 4%, which will then rise to 6%. And I can get into those details later on as to why that's happening. Within the California offset program, there are 4 protocols. Well, there's a forestry protocol. Within the forestry protocol, there's 3 forestry protocols: improved forest management, reforestation, and urban forestry. The other protocols are the ozone depleting substances, livestock, mine methane capture, and rice cultivation. Currently, it's estimated about a $2.4 billion market. That fluctuates at time, but it's an estimate. And about 200 million tons of supply or offsets within that program. And what's been issued to date is that number there. So quite a bit of movement forward. And there'll be further offset demand since the program has been expanded. It's also important to note that this doesn't include the other jurisdictions that are planning to link to California. So Quebec is not factored into this, as well as potentially Oregon. Pricing, you can see down here, this is year to date. It has not fluctuated too much. So there's not a lot of price volatility, but you're not seeing big swings upward either. When looking at developing an actual transaction, this expands off of my previous slide about the development process, but there's a multi-layered process to this as well. And I'll just go through this quickly, but as I mentioned, the developer usually will engage with an owner, and so that's usually what's considered the origination process. Can take a number of months at times. There's a lot of education, explanation that goes on in that engagement process. You then, if you're successful, you'll enter into an NDA or an LOI, and that typically looks at doing that with an end buyer. Sometimes intermediaries help on that. The end buyer will then start a process of due diligence, and the due diligence can really range on what the requirements are from their side, but oftentimes it can be early stage due diligence followed by a more rigorous review. You then factor in a number of contracting agreements, term sheets. Oftentimes they have what's called KYC, which is a know your customer review. And then a final purchase agreement is put in place between the project owner and the end buyer. So if you're a large forestry landowner and you developed a project, you would be contracting directly with that end buyer, is the typical standard approach. And then once your project receives issuance, that's where the money transfers and tons get retired. So I'm seeing I'm out of time here. I think I'll just end with some key takeaways. And then I can certainly talk later on. Got some more examples of pro forma that looks at kind of what's involved in developing a project. But more or less is that offsets can, as you're seeing, it's a complicated process. And it doesn't necessarily work for all types of projects. There are a number of kind of standard procedures that have been developed over the years, which now are allowing it to be more efficient. And there's a number of cost assumptions that need to be factored in, and I can refer to this at a later time, but this breaks down kind of the fixed costs on developing a project with some assumptions there. And very important to engage early on in a feasibility study. And I know we're going to be speaking about that later this afternoon, but that's a critical part to any type of project. So I think that I'll say mahalo, and we're going to turn it over to questions.